The euro just got hammered to 1.1464, a level that has every long trader questioning their existence. But here's what nobody's telling you. This sell-off is exhausting, and the next 48 hours could be the most important of the entire month. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, including a setup that offers a 3-to-1 risk-reward ratio from a level that most retail traders are completely ignoring, 0.1.1450. That's the number. And what happens there determines whether we are in a full-blown euro collapse or the buying opportunity of the quarter. Here's the truth. The euro to US dollar is in a strong sell trend across every single time frame, from the 1 hour all the way up to the monthly chart. The momentum is bearish, the structure is broken, and the bulls are bleeding, but here's where it gets interesting. And this is where the opportunity actually lives. We are now sitting directly on the S1 support level at 1.1450. This is the first line of defense, and it's been tested multiple times this month. Every time it's held, we've seen a sharp squeeze back toward 1.1590. So my session bias is this. We are in a trend-fading counter-trend bounce setup, but only if 1.1450 holds. If it breaks, we are looking at a freefall to 1.1394 and potentially 1.1310. Write this number down, 1.1450. If we break this level on a daily close, the entire structure resets and the next leg down begins. Now here's the micro insight most traders miss. The herd is overwhelmingly short right now. The commitment of traders' data shows net short positioning is near extremes, and retail sentiment is showing 75% bearish bias on euro to US dollar. When everyone is leaning the same way, the squeeze potential is massive. Let's look at the full picture, starting with the monthly chart, because this is where the real story unfolds. On the monthly time frame, the MACD is firmly in bearish territory. We've got a confirmed sell signal with the MACD line crossing below the signal line, and the histogram continues to make lower lows. The monthly ADX reading of 32.14 tells us this trend has strength. It's not just noise. The 200-month moving average is sitting way below at 1.1147, so we have room to fall if this trend continues. That's the structural bias you cannot ignore. Now when we drop down to the weekly chart, it's the same story, strong sell. The 20-week MA at 1.1567 was broken last week, and we are now trading below the 50-week at 1.1620. That's a bearish crossover, the kind that usually signals more downside ahead. The weekly RSI is at 33.6, which is not quite oversold. That's 30, but we are getting dangerously close. And here's what most traders miss. The weekly Williams %R is at -95, which is extremely oversold. This creates a contradiction. Momentum is bearish, but price is stretched. This is the divergence that smart money watches, down to the 4-hour chart now, and this is where the immediate trading opportunities live. The 200-period moving average on 4H sits at 1.1580, and we are trading well below that. But look at this. The MACD on the 4H is showing a subtle bullish divergence. Price is making lower lows, but the MACD histogram is making higher lows. This is the hidden divergence that suggests sellers are losing their grip. The 60-minute chart confirms the extreme oversold condition. RSI is at 33.6, Williams %R is at -95, and we are sitting on the 1.1450 support zone that's held 3 times already this month. Now let's get to the levels that matter. Key supports are clear. S1 at 1.1450, S2 at 1.1394, and S3 at 1.1310. Each one is a trigger point for the next leg down. Conversely, resistance levels are R1 at 1.1590, R2 at 1.1674, and A3 at 1.1730. The pivot point is 1.1534, and that's where the battle is being fought right now. Here's what most traders miss. We need to watch the correlation with euro to pound sterling and pound sterling to US dollar. The pound is also getting crushed, and the euro to pound sterling cross is moving in a way that suggests euro weakness is broad-based, not just dollar strength. This matters because if it's a euro problem, not a dollar problem, the bounce might be weaker than expected. The next signal changes everything, and it's happening on the daily chart right now. The 200-day moving average is at 1.1586, and we've been below it for 3 consecutive sessions. If we fail to reclaim it by Friday, the structure shifts from corrective to structural. So what's driving this collapse? It's not just technicals, fundamentals have shifted dramatically. The Fed is not the Fed of 3 months ago. The market has repriced rate expectations dramatically, with futures now pricing in only 2 cuts for the remainder of the year versus 4 just a month ago. Real yields in the US have risen 15 basis points in the last week alone, and that's a direct headwind for the euro. Yesterday's news was relatively quiet. Euronext wheat holding steady as French heatwave offsets Chicago drop, but the real story is what's happening behind the scenes. The ECB is caught in a trap. The European economy is showing signs of weakness, but inflation is still sticky. The policy divergence between the Fed and the ECB is widening, and that's the primary driver of this move. Eurozone bond yields are falling relative to US yields, and the yield spread is now at levels that historically predict further euro to US dollar downside. Here's the cross-asset linkage that most retail traders completely ignore. Watch gold. Gold is still holding near highs, and the gold-euro correlation is breaking down. Normally, a falling euro and steady gold would suggest dollar strength alone, but the fact that gold isn't collapsing tells me there's a risk-off bid coming from somewhere else. Now, let me give you the 1 to 2 week directional lean. Bearish bias remains, but the market is oversold. The bounce probability is increasing, but the trend is still down. If we hold 1.1450, I expect a corrective move toward 1.1590 over the next 5 to 7 trading sessions. But if we break 1.1450, all bets are off and we are targeting 1.1394. The event that invalidates the bullish bounce scenario is a daily close below 1.1450. Conversely, the event that invalidates the bearish trend is a daily close above 1.1590. Do you think the euro breaks below 1.1400 this week? Comment yes or no. I'm tracking consensus. And trust me, I've been doing this long enough to know that when retail aligns 75% in one direction, the market loves to prove them wrong. Now let's talk about the elephant in the room, the Eurozone economic data coming next week. German CPI and EZ GDP revisions could be the catalyst that triggers the next leg, whether up or down. The market is pricing in a Eurozone recession probability of 40%, and any data that confirms or denies that will move this pair violently. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1. The sniper, conservative. This is for traders who want the highest probability setup with controlled risk. Entry condition. Wait for a clear bullish reversal candle on the 4-hour chart from the 1.1450 support level. I want to see a hammer, a bullish engulfing pattern, or a bullish pin bar with a long lower wick that tests 1.1450 and rejects it strongly. The higher the wick, the better. This tells us the sellers are trapped and the buyers are stepping in. Trigger confirmation. The 4-hour candle must close above 1.1465, just 20 pips above the current price, to confirm the rejection. If we get a bullish close above 1.1465 with a long lower wick, that's our signal stop loss. Place your stop at 1.1425, that's 25 pips below the support zone. This is below the recent swing low and gives the market room to breathe. The logic is simple. If price breaks below 1.1425, the support is broken and the next leg down is in play. Target 1. 1.1520. This is the first level of resistance and represents the 61.8% retracement of the recent move down. At this level, you should take partial profits, 50% of the position. Target 2. 1.1590. This is a 1, the first major resistance level that's been tested and rejected multiple times. If price reaches this level, we are looking at a 90 pip move from entry with a 3.6 to 1 risk-reward ratio. What voids the setup? If we get a 4-hour candle close below 1.1450, not a wick, a close, this setup is void. Also, if the daily chart prints a close below 1.1450, the entire structure changes. Risk-reward ratio, 90 pips target, a 25 pip stop equals 3.6 to 1. The sniper, conservative, entry. 1.1465, 4H bullish reversal close, stop loss. 1.1425 take profit 1. 1.1520, 50% position, take profit 2. 1.1590 risk, air reward. 3.6 to 1 invalidation. Void if 4H candle closes below 1.1450 strategy 2. The active trader, standard. This is the pullback strategy that works best in strong trends, entry condition. Let the price bounce off 1.1450, then wait for a pullback to the 1.1480 to 1.1490 zone. I want to see a 1 hour or 4 hour retest of the broken support that now becomes resistance. This is the classic break and retest setup that institutional traders love. Trigger confirmation. A bearish reversal candle at the 1.1480 to 1.1490 zone. A bearish engulfing, a shooting star, or a pin bar with a long upper wick. Also, watch for the MACD to show a bearish crossover on the 1 hour chart. Stop loss 1.1525. This places your stop above the 1.1500 psychological level and gives the position room to breathe. The logic is that if price breaks above 1.1525, the pullback theory is invalid and we are likely moving toward 1.1550 to target 1.1455. This is a conservative target just above the support level, capturing the majority of the move. Take 50% off here. Target 2. 1.1394. This is S2, the second major support level. If we get a clean break below 1.1450, the momentum often carries to the next level. This target gives us a total move of approximately 80 pips from entry, trailing stop rule. Once target 1 is hit, move your stop to break even plus 5 pips. This guarantees a risk-free position while letting the second half run to S2. Risk-reward ratio. 80 pips target, a 45 pip stop equals 1.78 to 1 RR. The active trader, standard, entry. 1.1480 to 1.1490, bearish rejection, stop loss. 1.1525 take profit 1. 1.1455, 50% position, take profit 2. 1.1394 risk, air reward. 1.78 to 1 invalidation. Void if 4H closes above 1.1500. Type your euro to US dollar range for tomorrow in the comments now. Let's see who's aligned with the data. Strategy 3, the aggressor, high risk. This is for traders who are comfortable with high volatility and can manage risk aggressively. This is a momentum chase play, entry condition. If price breaks below 1.1450 on the 1 hour chart with a strong bearish candle, I'm talking a close below 1.1440 with the lower wick extending down, and the candle closes below the lower Bollinger Band, we enter a breakout trade. Trigger confirmation. The 1 hour candle must close below 1.1440, and the Williams percent must be below -90, which we already are. This confirms the momentum is breaking to the downside. Stop loss 1.1475. This is a tight 35 pip stop placed just above the break level. The logic is simple. If price rejects the break and moves back above 1.1450 quickly, the breakout is false and we want to be out immediately. Target 1. 1.1394, S2. This is the immediate target and offers a 46 pip move. Target 2. 1.1310, S3. This is the major structural level and offers a 130 pip move from entry. Risk-reward ratio. 130 pips target, a 35 pip stop equals 3.7 to 1 RR. Explicit warning. This is a high-risk strategy that should only be executed if you can lose small and manage risk aggressively. The breakout could fail, and the stop could be hit within minutes. This is not for the faint of heart. Consider reducing position size by 30 to 50% compared to your normal position. The aggressor, high risk, entry. 1.1440, 1H close below, stop loss. 1.1475 take profit 1. 1.1394 take profit 2. 1.1310 risk, reward. 3.7:1 invalidation. Void if 1H closes above 1.1450. Never risk more than 1 to 2% per trade. No positions through high impact. News. Stops are non-negotiable. This is how you survive to trade the next big move, and remember, the market is always right. If your stop is hit, accept it, step back, and look for the next setup. Discipline separates the professionals from the gamblers. Let me summarize what you need to know heading into the next session. The single most critical level is 1.1450. If we hold this level, expect a corrective bounce toward 1.1590 over the next 5 to 7 sessions. The oversold conditions on the weekly chart are extreme, and the hidden divergence on the 4-hour chart suggests sellers are losing momentum. However, if we break 1.1450 on a daily close, the next target is 1.1394, with 1.1310 as the ultimate downside target. The trend is still bearish, and any bounce should be treated as corrective until we reclaim the 200-day moving average at 1.1586. Tomorrow's focus is the U.S. consumer confidence data and speeches from Fed officials. The market will be watching for any hint of the rate cut trajectory, and that could be the catalyst that triggers the next leg. And remember, our coverage isn't just about euro to US dollar. The dollar is crushing everything, and we have a full breakdown on Bitcoin and the S&P 500 divergence. If you want to see how risk assets are reacting to the stronger dollar, that video is live now. Tap the end screen. If this gave you a clear plan, smash the like button. Subscribe, hit the bell, and I'll see you in the next one. Trade smart, stay disciplined, and never let emotion dictate your entries.